Yeah, man. Tango Hashtag and Mr. Quick Fix. So, to all those that have joined, welcome to another one of Bears, Bulls, and Pips' free pip session. You know, um, we like to do this as a measure of giving back to the trading community. So, today, basically, what is on the agenda is going to be chart patterns and why we need to understand them. Okay. So, uh, well, my brother, Mr. Quick Fix, isn't really in the best of conditions, but we send him love. He's getting better. I don't know if he wants to give a shout out. Will he give a shout out? He's not gonna give a shout out. But okay, we send him love, and we hope that he's great. But for the major part, we are going to be discussing chart patterns. Now, please give me a minute to get myself ready on the board. Yeah. Yeah, man, Sandu.
Can you hear me?
Sandu,
Hello,
grand.
sharp right now.
Yeah, man, grand. I'm living, bro.
Well,
Ah, you trade, bro.
yeah.
I trade. You know what chart patterns are.
Do I know what?
Chart patterns are.
Nah, not really. I'm here to learn.
I'll take that as a soft no.
Yeah.
All right. Yeah, I do. The whole point. That's why we are here. Cool. Right. So, first, let's start with what a market is, because chart patterns help us better understand market activity. Right. So, first, what is a market?
Okay.
A market can be defined as a place where, what's it called? When buyers and sellers meet, right? When a person is buying or selling something, or rather, when someone is selling something and someone needs to buy something, a market will occur, right?
Yeah.
A market exists when someone is looking for something to satisfy a need and when someone else has that thing to satisfy the need, right? So markets can exist
Yeah.
basically anywhere, right? Pick and Pay is a market. The local street vendor, Mamzo, is a market. Your uncle selling his car is a market, right? Because he's providing a need and someone else needs that satisfaction, right? So in terms of the market, oh well, the technical trading market, now that's the wrong term. The financial market, yes. In terms of the financial market, this happens with assets and securities, your gold, your Euro USD, your Nasdaq, your stocks, right? There's always someone who's willing to buy what you're selling or willing to sell what you're trying to buy. You understand?
Yeah.
That's a market when two people come together and agree that, okay, I'm selling you this for this much and you are going to buy it for this much, right?
Yeah.
So once we have that out the way, now we go on to better talk about chart patterns, right? So chart patterns are there to better help us understand the interaction and the relationship between the buyers and sellers, the bears and the bulls, at any given time in at any given time in the market, right? Whenever they form. So these
Yeah.
chart patterns are basically visual representations of price movement, right?
Okay.
Chart patterns. I'm gonna write this down. Uh, now we'll make minutes. So chart patterns are visual representations of price movements which happen as a result of the buyers and sellers interaction. And we as chart analysts or as a trader, you need to acquire the skill of being a chart analyst, right? So as a chart
Yeah.
analyst, when we study these patterns, we study them for the purpose of identifying potential trends so that we can make more sound and informed decisions on whether or not to buy or sell a specific asset, right? Because you
Okay.
can't just hop in there, you can't just hop in there willy-nilly saying, okay, I feel like buying or I feel like selling. You understand? You need to be able to read the patterns that are given to you at the specific time. So
Yeah. Okay.
patterns like I had patterns like I had previously said, um, came about or patterns come about as a result of the continuous and ever ongoing power struggle between the bears and the bulls, buyers and sellers, right? So
Mm-hmm.
this ongoing power struggle will inevitably result in the price fluctuations, right? In price going up and rising, or the fall of price, so price going down, selling, right? But eventually one has to give. Sometimes it's the buyers who make way and allow the sellers to sell, or the sellers give way and allow the buyers to buy, right? But in terms of chart patterns, there are three main types of chart patterns, and we're gonna go through
Mm.
them right now individually. So
Okay.
the first type of chart pattern, uh, or the first type of chart patterns are to be called trend patterns, right? So what trend patterns are, they basically represent to us the direction of the market, which is either up, down, or sideways, right? So you can either have an uptrend, a downtrend, or a sideways trend,
Mm-hmm. Okay.
right? Um, wait, can you please mention my synthetic? Oh, well, okay. I'm reading a message now by Mr. Quick Fix, and he's asking if we can speak about synthetics. Well, synthetics are a complex topic because synthetic indices, like in its name, it says which is this thing is synthetic. When something is synthetic, it means that it is um kind of man-made, right?
Mm.
But then synthetic indices are assets and securities, and that's that's market talk, right? I feel like that's a topic for probably next week or the coming sessions. But just know that synthetic indices were basically constructed or made so that they can sort of imitate real world activity, just like your Euro USD moving up and down because of certain fundamental data, like saying, for instance, the USD had lower earnings this year. So whenever the news comes out, it's gonna move down because of what the news report that came out to say that USD is performing bad. Or when
Okay.
Euro does good, you understand, then the Euro goes up. But synthetics doesn't have any news. Synthetics is purely just price action. It moves because of what is it called? They like to call it a big word. What is it? Cryptographically generated numbers. So what cryptographically generated
Mm.
numbers are basically, what is it? Numbers on a computer that are randomly generated. But there is a pattern to this random generation because you can still trade chart patterns on synthetic indices, right? So the same way you can trade a double top or a double bottom or trend reverse or trend patterns on synthetics is the same way you will trade Euro USD patterns and all that other stuff. But that's a different topic which I want to go in depth with in the coming Sundays.
Okay.
Right. So to pick up where we left off in terms of today's session, we were talking about trend patterns and how these patterns represent to us the direction of the market at any given time. Right. So I don't know if you know trends, right? So
Yeah.
let me switch on my camera.
Hmm.
How do I make the thing go other way? I wanna make it go other way. Sure. All right. So let's see that. Basically, what trend patterns are patterns that identify to us if the market is going up, right? The market is going up, or if the market is going down, right?
Mm-hmm.
That's what trend patterns are. Now, like I said, there are three basic types of patterns, and the second type of pattern that we have is the continuation pattern, right? So now, what are continuation patterns? Continuation patterns, you can think of them as sort of when the market takes a temporary break or rather a breather so that it can continue in the overall trend because a market won't go up forever and it can't go down
Yeah.
forever. So a continuation trend or continuation pattern, which is a result of the market not being able to go up forever, result or come about as flags and pennants, right? So remember, we have what is it called? The trend patterns, which go up, right? But because the
Yeah.
market can't go up, there has to be that small pause in the market before it finally goes up, right?
Yeah.
I hope I'm making sense. It goes down, then it goes up. This is when the continuation patterns are most relevant, right? Because this move here, this one here, the long one, tends to be called an impulsive move in the market, which can, depending on your time frame, last for a while. Sometimes it can be a 15-minute impulsive move, a 1 hour impulsive move, a 1 day impulsive move where the market had been going up for technically a long period, like maybe 7 days, the market was just continuing to go up and go up and go up until eventually,
Yeah.
maybe 4 days into the month, it calmed down and made this continuation pattern, right? When it took a breather to say, okay, you can't go up forever. So you've
Yeah.
got your trend patterns, then your continuation patterns, your trend patterns, continuation, aka the impulsive move, then the corrective move, impulsive move, then corrective move. This is basic market or trend
Yeah.
direction. You understand?
Yeah.
Uh, what's this called? So after continuation patterns, like we had said, these are patterns that happen because the market has to take a breather. We follow up with, lastly, the reversal patterns, right? So I think reversal patterns, it's in the name, but to properly explain it, reversal patterns are basically patterns that tell us, the chart analyst, when the overall trend is potentially about to change. And this often occurs at the end of either an uptrend or a downtrend, which then indicates the change in market sentiment. So this is a visual representation of when buyers are saying, okay, this cartel, we are now tired of buying, it's time to sell. Or when sellers are now saying, uh, excuse me, or when sellers are now saying, okay, It's been time to sell. Now it's time to buy, right? So
Okay.
reversal patterns are kind of like this, right? So a reversal pattern will happen. Let me do this. 3 mentorship. So right, we had the trend patterns and then continuation and then trend and then continuation and trend. This is an uptrend, by the way,
Okay.
right? So then a reversal pattern usually occurs at the tip, right? Right here at the top, then market reverses, then we go down, right? Now the trend has changed and now we are in a bearish trend. Then we get that retracement to the top, then price drops again. Then that retracement to the top, then price drops again, right?
Mm.
This is what we're basically talking about. The reversal patterns, my bad. The reversal patterns. When things how can I say this? Yeah, when the market starts slowing down, when buyers stop buying and now sellers start increasing in their power,
Mm.
right? So I feel like in the coming Sundays we'll go more in depth with the types of patterns or the most occurring patterns, um, so as to better equip you all with more understanding about the trend patterns, the continuation patterns, and the reversal patterns. But for now, do you have any questions so far, bro? Is everything making sense?
No, you're explaining it well. I understand.
Yeah, everything is making sense.
Yeah.
All right. So, let me clean the board for me. Right. So in the coming Sundays, we'll be better explaining the patterns, go more in depth and explain how patterns form and whatnot. But patterns basically form as a result of a series of highs and lows, right? When people have
Mm.
bought and sold, and then eventually it's that thing of, oh, that has happened after a certain amount of candlesticks happened, and bam, that's a pattern, right? Because
Yeah.
chart patterns happen as a result of traders and investors sort of displaying similar behavior and usually making decisions based on similar factors, which now include technical indicators or fundamental analysis, like I had mentioned, or basic overall market sentiment, right? Now, these
Okay.
patterns come up as a result, once again, as a result of the psychological factors and trading strategies that are used by market participants. So psychological factors being like when the market has been too high, right? People want to sell
Mm.
because the market is making an all-time high, and now, well, it's too high. Now it's time to sell. Or like I had mentioned once again, the fundamental analysis thing. Once a report on USD JPY comes out, or USD or the JPY, when a report comes out on the USD or the JPY, a decision will be made in the investor or the trader's mind to say, okay, because of this news, I'm going to react like this to um or with the market rather. So if maybe the USD had good earnings, the USD JPY is expected to buy because what USD is the one that did good. Or if the JPY does bad, once again, the USD will go up because yeah, USD is the base
Yeah.
currency of the USD JPY, so it's gonna go up. That's a psychological factor to say because
Mm-hmm.
there's good news on this specific asset, I'm going to react like this. Or if there's bad news on this specific asset, I'm gonna react like this.
Yeah.
Uh, now my last point goes into saying that we study chart patterns to kind of anticipate price movements and make predictions as to figuring out the market's behavior, right? But it's also important to remember that these chart patterns are not a foolproof plan or something that you should base your technical analysis solely upon, because this is just one aspect of the chart.
Yeah,
Excuse
okay.
me. When you are going to be deciding to take a trade, you must consider other factors um in your analysis, because now once again chart patterns can fail, bro. Like a chart pattern will print,
Yeah,
and in you having kind of back tested for a certain amount of time, you'll say, okay, now this pattern is sound because it's happened how many times before. But then market being market is going to say, oh, okay, so there's so many of you watching this pattern. I'm not gonna do what you expect me
mm,
to do because there's too many of you, so it's gonna jigela you. But because maybe you had included maybe fundamental analysis or a specific indicator. When that chart pattern prints, okay, this chart pattern is like this, but my fundamental analysis and the other indicator are telling me a different story. So what I'm expecting
yeah,
to happen might not happen. Because with patterns or chart patterns more specifically, even though it's something that has happened before, it's never going to happen the same way. You must understand that
yeah,
every moment in the market is unique, right?
okay,
You're never going to make 1,000 pip move the same way you did last time. So you must understand that every moment in the market is unique and anything can happen. When you expect to
yeah,
buy, the market can sell. When you expect to sell, the market can buy. So it's just a matter of being aware of all the factors or as many factors as possible that can influence price and isolate the most the most potent one, if I can put it like that.
yeah, okay.
Yes, my brother said it best. Trade like the banks, not the retailers.
Yeah, that's true.
You feel? So I don't know. Is there anything you'd want us to touch base on more?
Mm,
Mm,
you know? Okay. Excuse me for that. Um, I like this is just a questionnaire. I need you to
yeah.
like take me through how do you prepare for a day, like a day of trading. Like, what do you look at?
How I specifically me.
Yes.
Okay, me, I'm primarily a synthetic indices trader, right? So what I basically do is, well, it depends on the day. I don't have a specific routine I get into every time. I'm liable to wake
Yeah.
up. Oh, so I'm gonna take you through two scenarios, right? On a good day,
Okay.
I'm liable to wake up at like 2 a.m. When I wake up at 2 a.m., I sit down, I analyze the charts, and then I'm liable to wait for my setup to play out. But before that, I like to revisit my trading plan to remind me of what exactly I'm looking for and how I'm supposed to act in the market, because a nigga needs a trading plan. Like I don't
Yeah.
think people talk about that a lot. Like you need a trading plan. And I feel like okay, yeah, a trading plan is something yeah, trading plan is something I'm going to discuss again in the group, but I like to take a look at my trading plan and remind myself of I'm specifically looking for, even though I've done my analysis, right? So
Mm-hmm.
that's scenario number one, when I'm able to wake up at 2 a.m., spot whatever trend I'm looking for, and boom, I either take a trade or wait for the market to develop into the setup that I'm looking for. And then
Okay. Yeah.
scenario num scenario number two is when I have I haven't woken up. I missed my 2 a.m. window. and I wake up at give or take like 6 a.m. when the market has already developed and things are already happening. Because now with the synthetic indices market, it opens at 2 a.m. like I'm saying, right? Because
Mm,
now it's 2 hours behind. So for me, 2 a.m. is 12 a.m. for the market. So at 6 a.m. it's
yeah.
probably like 4 a.m. for the market. And now by that time, the market has already made a couple of trends. It's 2 hours into the market already. So I'm I'm still analyzing, but then I'm not as jolly anymore. I'm still waiting to catch my my specified trends, but I'm kind of not as happy anymore because I didn't wake up
Yeah.
early. Because I don't know about you, but I like catching like the overall day's movement. I like catching it just as the market opens,
You
and
like
then
seeing it from the start.
yeah, I like placing the trade, then going about my day, and then allowing it to develop. Wherever it closes, it closes. You
Okay.
understand?
Yeah.
Because my trading style is basically day trading or intraday trading. If it's possible to swing, I will swing. But if there's no opportunity, man, stop loss will
Yeah.
get hit
Yeah.
and then you carry on about your day. Nakona futhi like
Okay.
abstract, Mr. Quick Fix is bringing up an important point to say that sometimes you don't always have to place a trade. Like I'm saying, if
Yeah,
my
that's true.
specific you feel if my specific trade variables don't present, then there's no trade going to be taken. Hence why I like waking up early to figure out if we're taking a trade or not.
Okay.
You feel?
Yeah.
Yeah. Anything further?
Mm, I haven't really gotten into synthetic trading. I've been watching you guys. I've been on them on it. I'd
Sure.
like to ask, what do you like? What would you say is the best amount of money to start with?
Personally, that depends on you and your risk tolerance. Because me, I can handle, say for instance, sometimes, well, depending on my situation, I can deposit like maybe $10 and grow that to a significant amount, right?
Okay.
I like to use minimum deposit as a challenge for me, right? I'm not recommending
Mm,
this. I'm just saying I like to do it for me because I know I
yeah.
can handle
Okay.
that. You understand?
Yeah.
But
Okay. Yeah.
as as a good amount, I'd say $100. But then again, this is
Mm,
not me giving out financial advice. It's just me, you know, it's,
okay.
it's education.
Yeah. Yeah. Yeah.
I'm not sure. So yeah, it basically goes with your risk tolerance. So,
Okay.
cause
Yeah.
like
Because
you
I
like you
haven't
say
been able
on
to.
yeah,
Yeah.
you haven't been able to.
I haven't been able, like, I haven't found success in starting with like $10. I always, win and then lose, go back to like $12, and I have to come back again. You understand what I mean?
Yeah. It happens, bro. It happens. Trust me. Even now, still, it happens. But
Yeah,
personally, it's just a matter of risk management, bro.
yeah, true.
You have to be
Yeah.
you have to be a risk manager first before you're a trader. That's one thing I feel
Mm,
like has saved me. You have to be a risk manager first before you're a trader. Because
nah,
so
that's
everybody can
real.
trade.
Can I pop
You
in?
understand? Everybody can trade. It's just that matter of risk management. Yeah, man.
Yeah, can I just pop in with that statement? Ne? Like I was having a conversation with someone earlier, in the week. So how I would like to mitigate that thing of like using minimum deposit is that on your trading account, you don't necessarily have to put that $10 there and try trade that $10. So you could just start
Mm,
by starting out the week maybe with like $2 or $2.50 and see if you can push that. If that doesn't allow you to, because then you can take quite significant amount of trades with $2.50. You can take on a good day, you can take
Bro, like
trades. You could take
it can make mad, bruh.
you know, so, and just take
Yeah.
that, flip it to 10, and then just reset your account balance, your trading account balance to $2.50. To what? To mitigate that whole thing of like over trading and thinking that okay, I made this much, let me try flip that. No, you don't have to do that. So you can just leave the rest at dashboard and then go use your $2.50. It pastas, you let it go for the day and you carry on until and then the next day, boom, $2. So you can stretch what you call this $10 quite a significant distance if you use proper risk management
Yeah.
at the end of the day, you know. So yeah.
Okay. Okay.
You feel that? Like
Yeah.
you're saying, it's proper risk management, bro. You're risking a specific amount of your capital, not your whole capital, a specific amount. And like that, two
Mm.
dollars today can be $2 tomorrow, $2 Wednesday, $2 Thursday. You're not liable to risk or lose the whole $2. You are gonna lose maybe $2 today, then tomorrow you make what, $12 again. Then you move that other
Yeah.
12, put it back in dashboard. Then that $2 is for when? Thursday again. You lose the $2 on Thursday. You come back Friday with $2 again from the previous $12 that you already had made.
Yeah. Okay. Yeah, I understand.
You see the vision.
Yeah.
Yeah.
Yeah. So
Okay.
how I'd like to put that is like when trading, think about your next 100 trade, you know, because so how that implicates itself is that you know you understand that okay, today may not be my day, but then if I can just risk this certain amount, maybe when it is my day, I'll have an amount to trade with, you know. So you just need to think ahead.
Mm.
You know, part of risk management is also thinking ahead. You know that like okay, boom, when you enter like okay, boom, today I might not make what I've intended to make, but then I know that
Yeah.
tomorrow, if it's my day, I still have some capital to use. You know, so it's about like how I see it in trading. Like my brother here has mentioned before, is that you know it's all about having a significant edge in the market because we all don't know what's going to happen in the market, you know. But then for the people
Yeah.
who have an edge to the market are the people who most of the time come out triumphant because what they mitigated their edge and used it to their advantage, which is why also knowing these chart patterns as you're gonna go into them weekly in like a form of series, you know. Yeah, you just
Okay.
those things, understand, they can really like take you a long way if you really stay persistent in them. And as a person too, just having self-discipline too. You know, I feel like that's the only way
Yeah.
you can really work proper if you have your own self-discipline and your own set of morals that you go by. That okay, if I don't see this, I don't enter. If that doesn't tell me that, I don't enter. And you leave it like that. And so
Yeah. Okay.
yeah.
But yeah,
All right.
what needed to be discussed was discussed, and I hope you're able to take something away from this. So
Yeah. No, it's really helpful. Thanks.
And
yeah, man.
one last thing in closing, yeah. I want you to understand that if you are in this channel or whatever, for the people who will be watching later on, if you're not in the
The
position,
organization.
yeah, if you're not in the position to what you call this, to trade with large capital or whatever, you know,
Mm-hmm.
understand that, or if you're scared, basically I want to address the fear. If you're scared, you know, understand that you are at the point where you are liable to take such financial risks because you don't have major things to do. You know, so take those financial risks, you know, and actually get into that real account and you know make sure that you
Yeah.
consistently done, you know, like take that risk and take initiative.
But
But
can I take it away? Like
sure,
my bad. Can I take it away? But you get rich by taking big amounts of risk with small amounts of money.
exactly.
But you stay rich by taking small amounts of risk